Welcome to Alternative Investments Chat,
where we demystify the world of alternative investments and financing for entrepreneurs and investors alike.
With these discussions, we hope you're more empowered to unlock opportunities in your business or portfolio. I'm Erin.
And I'm Erica. Let's get started. Hello, welcome back to another episode of Alternative Investments Chat. If you've been keeping up with us lately, you will most likely know that we've been talking a lot about stocks. Tons and tons. And while stocks are technically considered a traditional asset, and we like to talk about alternatives over here,
we it's in the name.
Right? Alternative Investments Chat, not stocks investment chat.
That's right.
That would probably be really boring. Although I don't know, stocks these days are kind of exciting. In fact, they're so exciting. That's why we've been talking about them a lot. And they're still really important, and they're necessary to dive into since they make up a very much of a substantial part of an investor's portfolio, right?
Yep, that's right.
So far, we've actually discussed common stocks and dividend-paying stocks, and today we're actually going to peel back the layers on preferred stock.
Yes, that's exactly right. If you were to take common stock and bonds and mash them together, make a little baby, you might end up with something like preferred stock. That's right. You know, preferred stock is a hybrid investment, kind of like a Prius, mixing something traditional.
Would you be talking about Priuses, ma'am, who owned one and had your Cadillac converter stolen how many times?
My catalytic converter was stolen twice, and my insurance company did think I was committing fraud, and I was not. But yeah, apparently the year that I had was made of like full platinum, so very valuable asset.
All right, so that's fine.
I still loved it. Great car.
I mean, I drove a hybrid for many years now, full electric. So
Great car.
I can't say anything, right?
Yeah. So it's kind of like mixing something a little bit more traditional and boring, like a gas vehicle, and putting it with something with a little more zest, like electric, you know?
I know.
And then you end up with something. Well, maybe a Prius isn't the best analogy because I know there's a lot of Prius haters out there. But anyways, let's just get to the point. What exactly are preferred shares? How do they work? And why do they matter?
Exactly. So let's get one straight thing. Let's get one thing straight. Okay, we're going to get through this. Preferred stocks goes by a lot of different names. So we're going to give you all of its aliases. You might hear preferred stocks, preference shares, preferred shares. Just know those are one and the same.
Yep, exactly.
The holy trinity of stocks, right? Finance people, they're always trying to make things more difficult by naming them 8,000 different things. So anyway, live with it. We did.
Yeah.
I hear it, and now I don't even hear it anymore. So we said that preferred stocks are hybrid investments, correct? So which it means combines features of equity ownership with fixed income characteristics of bonds. So typically paying consistent dividends, which we talked about dividends. We like dividends, while still representing ownership in that company. So like bonds, they pay regular income as long as everything is going as planned. Again, that's a big deal. Sometimes it doesn't, but we're going to pretend that everything is perfect in our little investment world
right now.
Okay.
Yep.
And have fixed valuation features. Yep. Which we'll get into more later. Don't worry. You're going to hear that, and then you're going to be like, what was that? What was that?
Yeah.
We'll cover that.
Put a pin in it.
Yep, put a pin in it. Something here to remember is while preferred shares have features that are similar to a bond, the returns are not guaranteed. Remember that dirty G word. We don't talk about that dirty G word. There is no guarantees. So if you're joining us for an episode about common shares, you may remember that common shareholders are the last ones that get paid. They're the last guys. And preferred shareholders, however, are different.
That's right.
They are higher up on the list and get paid after those creditors and the bonds. So another key feature of this security is that they often do not come with voting rights. Remember I talked about how I have an investment where I am an equity owner with no voting rights.
Yes. So this is
I'm a preferred.
Yes.
Obviously.
Preferred
stock owner.
Exactly. And you're exactly right. And there are many different types of preferred stock. And the category that the preferred stock falls into changes the factors such as income stability, risk, and fundamentally how this security actually behaves. The first category that you need to know about is cumulative versus non-cumulative.
Got it.
Cumulative preferred shares come with a helmet and knee pads. Basically, there's a clause that is in there to help protect you, the investor, if the company takes a dip. This is where you really get to feel like the VIP.
I like it.
If a company skips a dividend payment or a few to you because they can't afford it at the moment, those payments accumulate like a bunch of IOUs.
Hey, I like that.
Not forgotten.
Yeah.
And the company has to pay you back all the money that they owe you before paying the commoners. The common shareholders. And you might have guessed it, but non-cumulative stocks are basically like the get out of jail free card for the issuer.
Got it. Okay.
So if they miss a dividend payment, they aren't on the hook for the money that they missed giving you. It's basically like a oopsies.
Sorry, we didn't have enough.
I don't have enough money. I'm just a baby. And then they just get to move on.
Yeah.
But the upside to this type is that they're usually less expensive than the cumulative preferred shares. I guess having a helmet costs a little bit of extra money.
Yeah. Well, I wish I could get a oopsie if I loaned money or borrowed money from someone and didn't want to pay them back.
Oops.
Whoops,
Try it out. That's our financial advice for today. Next time you owe money, just say oops and see what happens.
I'll see what the bank says when I go to take out a loan for my house. Like, I'll be like, oh, sorry, couldn't pay.
Oopsies.
Whoopsies. And then we become a meme.
Yeah.
When we're in handcuffs going to jail.
Exactly.
Our next category actually to discuss is callable preferred shares. So not like on the phone call. But most preferred shares are what is called callable.
Yes.
Meaning that the issuer can actually buy back their shares as a set price and a set date. So they're like, hey, you have this until this many, and then I want them back.
Yeah, exactly.
You can borrow my shoes for this many days, but then I want them back.
Right.
And you can't walk in mud. The set price is typically the par value, which is the original value assigned to the stock or bond when it's actually issued. So if you buy it for $10, when you buy it back,
when they want it back,
they'll buy it back. If the par value is $10, they're going to give you $10, right? But a company might do this if their interest rates fall or if they can refinance at a lower dividend rate, aka if the company can get a better deal, they might call their shares back. So now here's the downside, that $10 thing for the investor. If you bought shares above par value, so let's say you bought them for $10 and now their par value is $8 less, or anything under 10 basically, you end up losing money. That's not very fair.
Yeah.
It happens.
Yeah, exactly. If the stock somehow goes up, which we'll get into how this stock can rise, but if the stock goes up and you're feeling like it's a good deal and it's at $15 and you buy in and then a little while later they say, just kidding, we want those back, they're only going to pay you $15 or $10 per share, whatever that par value is. So you've now lost $5 each, which is a bit of a bummer.
It is a big bummer. So up next, we have participating preferred shares. So these are the kinds of like the little black sheeps of the family. They're the little outcasts. They're the ones who sit in the corner and play on their like Stitch or Switch. Is that Switch? They're playing Stitch on their Switch.
Love that.
I have nephews, obviously, that are teenagers. They are not actually super common, but they're pretty cool if you actually look into them. So with these, you get regular dividend payments per the usual. But participating preferred shares can potentially offer additional cash, like extra money. So that's money on top of money.
Yes,
and we like monies on top of monies, right?
Stack it up.
If the company achieves certain financial goals that they set, they will distribute dividends above normal set rates of these shareholders, which is awesome. So think of it like your bonus your employee might give you as a gift.
Yeah.
Your employer might give you as a gift to everyone for hitting like record sales in the company. So the company is doing really well. And so they spend some of that extra cash to their employees.
And they share it around.
They share it to you.
They share the wealth, which is very nice. I love it when people give me extra money. I wish that would happen more often.
I'm waiting.
Yeah, I'm waiting. Anytime. Any day is a great day to get extra money. So keep that in mind. Our last major category that we're going to talk about here is convertible preferred shares. These types of shares can be turned into common shares at a predetermined ratio. Okay, we're going to
get not top-down convertible. It's
exactly.
Hair-blowing convertible.
We have a little bit of a ratio going here. We got some math. So strap in to your convertible as it will, and be ready. It's not very hard. We'll get there. Let's give a little bit of an example how this works because it can be kind of tricky to conceptualize just talking about it. So let's say that you bought 100 shares of convertible preferred stock at $25 each. So your investment amount is $2,500. Your predetermined conversion ratio is 1 preferred share to 2 common shares. And you'll know that when you make the investment.
Yeah.
So
They'll
let's
spell all this out for
yes. So let's say right now the common stock is trading at $10 per share. So using our ratio, that means that your 1 share of preferred stock is worth $20 if you converted.
Got
See
it.
how that works?
Mhm.
Multiply by 2. Since you bought your shares for $25 each, not a good deal. That would mean that you would lose $5 on each share that you converted to common stock right now. So we're going to pass on that. We're going to say, no thanks. I don't want that. So let's fast forward. And now let's say that the common stock price has risen to $18 per share. Using our same math from before, that means that one share of your preferred stock is now worth $36, 18 times 2. Now, this is looking like a better deal, right? So you decide to convert all of your shares and you walk away with $3,600. Since you put in originally $2,500, you've now made a profit of $1,100. Pretty good.
Yes.
And not to mention, you've likely been collecting dividends along the way up until that point. So hopefully your returns are even higher than that.
I love that. And sorry, listeners, we should have provided scratch paper and pencils and a calculator for this portion of the podcast episode. But again, it's not that hard.
Not that hard.
It's pretty simple. Nothing that, a normal calculator app, I was going along on the computer, can't handle. Okay, so we've talked a lot about dividends in the past. But who determines those dividend rates and how, right? So the rate is determined by issuing companies, but they don't just pick a number and run with it. They're not like, hey, I just want to make it this one. And
right.
They're like, this sounds like a good number. Like for me, I know this is weird, but do you have a favorite number?
4.
9.
Nah, there we go.
Isn't that weird?
Yeah.
And 19 too.
9,
9, 19, and 9,000. I have 3. I don't know. Don't
Nice.
ask. But those are my favorite numbers.
I like
so
that.
if I was like 9%, everyone's going to be like, yes, we want to invest, but I might not be able to pay that.
Yeah,
right?
sure.
So the rate is influenced by a lot of factors. Market interest rates.
Yep.
Company's credit, demand, if people are going to pay for it, comparable preferred securities, and of course, the type of preferred shares like cumulative or convertible, et cetera.
Right.
So from there, there are different kinds of dividend rates.
Yep.
So let's start easy with fixed rates. We like that word, It sounds, it is exactly what it sounds.
Don't have to think about it.
Dividend rate is set and it don't move.
Yes.
Set it and forget it.
Yep.
Isn't that a being back in the day? So anyway, so if the dividends are a rate of 6% or 9%, if you're working for my company, because I like the number 9, and the par value is $25 per share, you'll get $1.50 of dividends per year per share.
Yes, exactly. Sweet.
Money, money, money.
Love that. Extra money. And another option is floating rate or adjustable rate. And with this type, the dividend rate resets periodically. And there's another option that's kind of like a combo, fixed to floating. And this means that you start with a fixed rate for a period of time and then it moves on to be a floating or adjustable rate.
Yep.
So how do you get your hands on these bad boys? How does that even
Please
work?
explain. I want some.
Well,
At least I feel like I want some.
Everybody wants something they don't have. Although you have it.
I have dividends. I do have fixed rate stock.
We can't even pretend you already have it. Well, the steps are basically the same as investing in common shares. We gave a full rundown of how this works in our common stock episode. So if you want a more in-depth review of how to do this, check that out. But basically, you open up a brokerage account. If you don't have one already, you find the preferred stocks that you like via your broker. This is like an online platform. And then you place your order and you see your stocks populate in your brokerage account. Done. Preferred stock is on the open market and is generally open to all retail investors, meaning you don't have to be accredited to add them to your portfolio, which is nice.
That's absolutely correct because look at me, I'm not an accredited investor, but
I would have never guessed.
I know. I hold my accreditation so well, right? I just beam accreditation.
Exactly.
No, but that's how I do all mine. So the only caveat here is that some preferred shares are often they're offered through that private placement.
Yeah, exactly.
And that's when you need that accreditation. As you know, some private investments have certain restrictions like being accredited, and a sometimes very high minimum to invest. And it's all based on those security laws.
Yep,
right?
exactly.
Again, I think we did an episode on some of those. So go back in our little catalog of fun check them out. So now let's talk about our favorite subject, you, the investor, the listener. Why might somebody consider adding this type of security to their portfolio? Well, let me tell you why. Because preferred shares strike the balance between common shares and bonds, like we said, that nice little hybrid. They really work for investors focusing on building income. Okay, this is not a get rich quick. There we go. My words will come to me shortly. The yields are generally higher than dividends on common stocks and mini bonds. And there's a lot of these asset classes we talk about on this podcast involving locking up your money for a period of time and seeing the returns later on, right?
Yep.
A lot of private investments work this way, as we just talked about. Kind of like a piggy bank, just sits there that you put your little money in, and then you have to break it to get it out, but you can only break it after a certain amount of time, right? Dividend-paying preferred shares can allow you to actually enjoy your returns as your investment continues to mature, as opposed to waiting for that investment to mature before seeing any returns.
Exactly.
So you can get out a little bit early.
Yep, and that can be really rewarding for investors. And here's some more pros to consider. They also can carry tax advantages in some jurisdictions where qualified dividends may be taxed more favorably than interest income. And as we mentioned earlier, if the company goes under and you are higher up on the food chain when you have preferred shares, so you can potentially get your investment back, which can feel less risky for investors. Now, of course, this doesn't mean that you are guaranteed to get that money back, but you might feel some comfort in knowing that that is a possibility.
Yeah, and I know we mentioned this earlier, but just to be clear, as always, as much as we possibly can.
Let's write it out.
Just because you have invested into dividend-paying preferred shares does not mean that you're always going to be receiving that payout. Again, we just said that dividends can be suspended. And depending upon the type of preferred stock you invest in, rates might dip, meaning that the average rate you thought you were going to get might not align with reality.
Yeah.
So you might be getting that 9% from me. And then all of a sudden I'm like, well, shoot.
Never mind.
Can't do that. Here's 2% because that's more realistic. You have to be, you have to factor that in.
Yeah.
Additionally, a majority of preferred stocks can be traded on major exchanges, just like common stocks. But some can be a little bit more tricky, as some preferred stocks trades less frequently than common stocks. So liquidity, again, can be a little bit of an issue potentially if you're looking to get out early.
Exactly. And that's definitely something to look out for. And something we talked about in our common stock episode that is that common stock can grow infinitely in theory. There's no cap on how much common stock can be worth. And this is not the case with preferred stock. The value of the stock is not tied to how well the company is doing. Let's take a closer look at common stock for just a second to draw a comparison. We all remember in 2024 when the door plug blew out of a Boeing 737 MAX 9 mid-flight. I mean, how
can
could
you
we
forget?
I think that's everyone's nightmare.
I think after flying, every time I booked a ticket, I looked at kind of what plane I was getting on because I was like,
this
ain't
day
gonna be
I
me.
do that. Yeah.
Ain't gonna be me.
Is that a Max? I'm not going. Sorry, Boeing. No shade to you. Hope you figured that out, girl. But anyways, right after that incident, Boeing stock fell nearly 10%. So the value of the stock, common shares, is directly tied to how well the company is performing. In a major incident like, a door flying off in the middle of a flight makes people value Boeing stock less. Yeah. Don't blame them for that. Sorry, Boeing. Yeah. Sorry, girl. Keep it safe, okay?
Keep it safe up there.
With preferred stock, the value is tied to its par value plus accrued dividends. So there's less potential to make a crazy amount of money. It's not like you're going to see a return that's like you bought a stock for $10 and now it's worth $500 a share or something crazy like that. It's like you're not going to see that here. But you trade that potential high upside for income and more stability. They're perceived to have more stability. And so when investors ask, where can I generate income without moving fully into bonds, or maybe having some bonds and maybe you want to expand a little bit further your portfolio, preferred shares can potentially be part of the answer.
I like that. So what do we really learn here today?
Great question. Don't fly in a
Boeing.
Boeing 737, whatever the hell it is.
No, preferred shares aren't designed to be thrilling. Okay. They're designed to give investors more reliability. I wanted to say stability and reliability, and I was trying to combine the words. Words are hard, and I love to make them up. Yeah. But they can provide predictable income, defensive stability, and a middle ground between those stocks and bonds, especially for those investors focused on cash flow, again, rather than rapid growth.
Yep.
And, while they don't replace growth equity, we want a little bit of those in there too.
Sure.
They can play a very, very important role in diversify, there we go, income-oriented portfolios, which is what I think every investor is kind of aiming to do.
Yeah, exactly. Your portfolio is like a buffet.
Yeah,
you want to get a little bit of everything.
I want to try a little bit, So basically, that's it for today's episode on Alternative Investment Chat. And as always, we hope that this conversation hopefully helped clarify how preferred stocks work. We didn't confuse you too much and where they might fit into your portfolio, especially if you're trying to come up with a very thoughtful investment strategy.
Yeah, exactly. Branching out into new things.
Yep.
And if this episode helped to expand your perspective on income-focused equities, maybe share it with a friend or a fellow investor. Maybe there's someone that you talk about investments with a lot. Maybe share this with them. And so you both can chat some more about building a portfolio with intention. Maybe bring this conversation to your advisor.
Sharing is caring.
Sharing is caring. That's right. Pass it on. Be sure to subscribe, turn on notifications, and leave us a review or a comment. That really helps us continue the show and learn more about our listeners and what you guys want to hear.
Yeah.
But that's it for today. So we will see you next time. Thanks for tuning in.
Thanks for joining us. Stay tuned for more insight on our next episode.
And don't forget to subscribe to continue the Alternative Investments Chat. See you next time.
The content provided in this podcast is for informational purposes only and should not be construed as professional financial or investment advice. This podcast should not be construed as an offer to sell or a solicitation of any offer to buy any securities. We strongly recommend that you seek advice from a qualified professional before making any financial decisions. The views and opinions expressed in this podcast are those of the hosts and guests and do not necessarily reflect the official policy or position of Invesio.